Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host Neena Mishra. My guest today is Lex Gerlach, Tactical Investment Strategist at ProShares. And ProShares is the world's largest provider of ETFs benchmarked to VIX futures indexes. So we are talking about the VIX and related ETFs today. And we know that markets have been quite volatile of late, and they usually tend to be volatile ahead of elections in October and November anyway. And this year, we know there's a possibility of a disputed election, and a surge in mail-in ballots is expected due to the pandemic, which may also result in a delay in election results. So the VIX, which is popularly known as the market's fear index, has been at elevated levels recently and may remain at elevated levels until we have more visibility on the election outcome. So this has, of course, resulted in a lot of interest in products that bet on volatility and VIX ETFs. But investors should remember that volatility ETFs are very complex products. These are very complex because VIX is a derivative, and ETFs based on VIX futures are derivatives on derivatives of derivatives. And if they are leveraged, then they are even more, complex products. So we decided to get an expert to discuss this topic. Lex, welcome, and thanks so much for joining us.
Thank you for having me today.
Okay, so to start off, please tell us what is the VIX, and since VIX is actually a measure of implied volatility, so please tell us what is implied volatility, what is actual volatility, and how is the implied volatility different from actual volatility?
Sure, and this is a very important starting point if you are going to talk about the VIX. Implied volatility simply measures expected or forward-looking volatility based on prices of options. And this is different from actual or realized volatility, which is based on historical movements over a past period. Now, the VIX, the CBOE Volatility Index, references implied volatility. So it's really key to understand the distinction between implied and actual volatility. To answer your question, what is the VIX? It's an index that projects the probable range of movement, the percent change, in the S&P 500 as of 30 days from now at a 68% confidence level. So one standard deviation of the normal probability curve. And this is reflected in the prices of S&P 500 options. So this can be thought of as in 30 days, the S&P 500 is likely to be in a range of plus or minus X% from where it is now. Now, I do want to note that even though we talk about this in the context of a 30-day period, the stated VIX number is annualized. Another point I want to mention is that it's not practicable to directly invest in the VIX, which is often referred to as the spot VIX, or to replicate its performance. So many investors use products related to the VIX, such as ETFs that are linked to VIX futures contracts.
Thank you. That was helpful. And as you mentioned, the VIX index, which is often referred to as the spot VIX, it itself is not investable, but there are volatility-based products available to investors that includes futures and options. And then there are ETFs, which are based on VIX futures contracts. So tell us, what are VIX futures contracts? What do investors need to know about them?
VIX futures contracts give investors access to tradable S&P 500 future implied volatility by providing a way to take a view on the future value of the VIX. The price at which a VIX futures contract trades reflects the market's view of the value of the VIX on the expiration date of the VIX futures contract. VIX futures were actually first introduced to the market in 2004, and then in January 2009, S&P launched VIX futures indexes, the S&P 500 VIX short-term futures index and the S&P 500 VIX midterm futures index. The short-term index reflects expectations for the VIX in 1 month, and the midterm index reflects expectations for the VIX in 5 months. And to quickly summarize how these indexes work, they measure returns of a portfolio of monthly VIX futures contracts that have weighted averages of 1 month or 5 months to expiration. And this involves regularly rolling positions in futures contracts. So for the S&P 500 VIX short-term futures index, for example, to consistently maintain a portfolio of monthly VIX futures contracts with a weighted average of 1 month to expiration, the index rolls about 5% of its positions daily from the first month futures contract to the second month contract. Now, historically, these indexes have generally been highly correlated to the VIX, but typically have had a lower beta to the VIX. Since the indexes launched in January 2009 through June of this year, the short-term and midterm indexes have had correlations of about 0.9 and 0.8 respectively to the VIX. The short-term and midterm betas during the same time period have been 0.58 and 0.22, so roughly half and a quarter that of the VIX. On a daily basis, though, the correlation in beta to spot VIX can vary significantly at times from these longer run averages.
Yes, as you mentioned, the VIX and the S&P 500 index are generally negatively correlated, but that can change at times. And in fact, we saw in the past 2 months, the VIX rose even as the S&P 500 had, that also surged. It had some, July and August were among the best months in history for the S&P 500 index. So that probably just indicates uncertainties ahead. And when we talk about VIX futures market, we hear of terms like Contango and backwardation. So could you please explain what is Contango and what is backwardation, and how does Contango and backwardation, how do they impact futures?
Sure, absolutely. The VIX futures market is said to be in contango when futures contracts with longer expirations have higher prices than those with shorter expirations. And as you know, the VIX futures market has commonly been in contango, especially during periods when realized volatility is at average or below average levels. The futures rolling process used by the S&P 500 VIX short-term and midterm futures indexes can lead to roll yield or roll costs. When the VIX futures market is in contango, there can be a cost to rolling futures contracts. And alternatively, when the VIX futures market is in backwardation, there can be a benefit to rolling futures contracts. Backwardation just means that futures contracts with longer expirations are less expensive than those with shorter expirations. Backwardation has been most prevalent after a surge in realized volatility and has historically occurred much less frequently than contango. So how does this translate to fund returns? When the VIX futures market is in contango, which historically has been most of the time, there can be a drag on returns from rolling futures contracts in long volatility funds. Now, on the flip side, short volatility funds would benefit from rolling in this market environment. When the market is in backwardation, long funds would see a beneficial impact from rolling futures contracts, and there would be an adverse effect in short funds. Now, I do want to mention that the funds generally are intended to be used as trading tools for short-term investment horizons. And investors holding shares of the funds over longer-term periods may be subject to increased risk of loss.
Okay, so let's talk about the volatility products that ProShares offers. And I understand there are 4. So please tell us a little bit about those 4 products.
Yeah, as you mentioned in the beginning, we are the world's largest provider of ETFs benchmarked to VIX futures indexes. We have a suite of 4 funds that are benchmarked to either the S&P 500 VIX Short-Term Futures Index or the S&P 500 VIX Midterm Futures Index. And we launched all these funds in 2011, so they have close to a 10-year history at this point. As of August 31st, we have about $2.2 billion in assets across the 4 funds, but assets in these funds can change pretty quickly and meaningfully based on flows and market moves. So at the start of this year, for example, the overall assets in these funds was about $1.2 billion, so about half the current assets. 3 of our funds are benchmarked to the S&P 500 VIX Short-Term Futures Index, and the vast majority of assets in volatility ETFs are benchmarked to this index. Our funds offer a mix of long and inverse exposure to the short-term futures index. And on the long side, we have VIXY, ticker VIXY. That's the ProShares VIX Short-Term Futures ETF, which seeks to track the performance of the short-term futures index. And this is not a leveraged fund. We also have a leveraged version of VIXY, UVXY, ticker UVXY, and this is the ProShares Ultra VIX Short-Term Futures ETF, and that aims to provide 1.5 times the daily performance of the short-term futures index. Now, on the inverse side, we offer SVXY, ticker SVXY. This is the ProShares Short VIX Short-Term Futures ETF. And this aims to provide 1/2 the inverse of the daily performance of the short-term futures index. So we have 3 funds with daily performance objectives of 1, 1.5, and 1/2 the inverse of the S&P 500 VIX Short-Term Futures Index. I also mentioned we offer exposure to the Midterm Futures Index. VIXM, ticker VIXM, is the ProShares VIX Midterm Futures ETF. And this seeks to track the Midterm Futures Index and is not a leveraged fund. So that's a high-level overview of the suite of volatility funds that we offer, 4 in total.
Excellent. And you talked about Contango and backwardation and how they impact futures, VIX futures. And I'm looking at the curve now. It appears that the contracts which are maturing at the end of October and November, they are very expensive. And then VIX futures contracts which are maturing in December and then early 2021, they are trading at a slightly lower price. So that probably just reflects election-related uncertainty. So for investors who want to use these products, could you tell us how they should use these products in their portfolio? Should they be used as short-term tactical tools only? Should they be held only for a few days? Or can they be used as portfolio hedging tools? Can they be held for slightly longer period, maybe 1 month or 2 months, or that's not advisable?
Yeah, let me start with the long ETFs, VIXY, UVXY, and VIXM. These are tools for investors seeking to profit from increases in the expected volatility of the S&P 500. Now, they can also help to reduce U.S. equity portfolio risk, since changes in the VIX futures indexes have historically been negatively correlated to S&P 500 returns. And just to quantify that, with the S&P 500 VIX short-term futures index, for example, its correlation to the S&P 500 since inception in January 2009 through June 2020 has been negative 0.73, and its beta to the S&P 500 has been negative. So we do often see investors using these funds for portfolio hedging strategies. The inverse ETF, SVXY, can be used by investors seeking to profit from decreases in the expected volatility of the S&P 500. Now, I would like to note that volatility ETFs, they are intended for short-term use. And for anyone choosing to use these funds for periods longer than a day, we would encourage them to monitor their holdings on a regular basis, even as often as daily. If you hold these funds for longer periods of time, you can risk losing a meaningful portion of your investment, or even all of your investment, even over periods shorter than 1 day. So it is important to be thoughtful in how you intend to use these strategies. Investors holding shares over longer-term periods may be subject to increased risk of loss. So these are some considerations to be mindful of.
Any other risks associated with these products that investors need to be aware of?
Yeah, there are considerable risks related to investing in ETFs benchmarked to VIX futures indexes, and they're not suitable for all investors. For anyone considering these funds, we really encourage them to take the time to educate yourself and understand the risks. VIX futures indexes can be highly volatile and have historically been significantly more volatile than major stock market indexes. It is possible that an investor could lose the full value of their investment even within a single day. Another important point for consideration is that the VIX is mean reverting. Unlike other asset classes, like broad market equities, for example, that may increase in price over long periods of time, the VIX has tended to revert to a long-term average after periods of higher or lower levels. So any gains from investments in funds that invest in VIX futures contracts can be constrained and subject to significant and unexpected reversals as the VIX reverts to its long-term average. I'd also like to mention something I touched on earlier. VIX futures indexes have historically reflected significant costs associated to rolling VIX futures contracts on a daily basis. These costs can consistently reduce returns, especially for VIXY, UVXY, and VIXM over time. Additionally, the fund's investments may be illiquid, and the funds may experience large losses from buying, selling, or holding such investments. Lastly, volatility ETFs that have daily leverage or inverse objectives tend to magnify risks. And due to the compounding of daily returns, the funds are not designed to deliver the fund multiple times the index returns for periods greater than a day. So these are some of the main risks to be mindful of. And again, I really encourage anyone considering these funds to take the necessary time to learn about them.
That's very important because these are very complex products. So for investors, if they're interested in investing in them, they should first learn about those products. And I think mean reverting is a very important point that investors should remember, because unlike stocks, which generally increase in price over a long period of time, VIX reverts to long-term average after periods of higher or lower levels, as you mentioned. Any other closing thoughts or considerations for investors who are considering these volatility ETFs?
We covered a lot of important points here, and I hope this has been helpful. I do want to mention a few ways people can continue to learn more. There are a number of great educational resources available to investors, either through ProShares.com, but also through the CBOE and S&P, for example. You can find materials directly on their websites.
Excellent. Lex, thank you so much for joining us today.
Thank you very much for having me on today.
Thanks for listening. If you want to learn more about these products, please visit ProShares.com. Make sure to be on the lookout for the next edition of ETF Spotlight. And also make sure to subscribe. If you have any comments or questions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.